Migration is pivotal when you're talking about multifamily investing. If you're not considering migration, then you are really, if you're doing well, you're lucky. If you're not doing well, now you know why. You really want to make sure wherever you're investing, there's a path of progress, there's job creation.
Welcome, everybody. Today's episode, we got with us Ravi Gupta, co-founder and COO of Viking. And today we're going to dive into migration. So, this is a real estate podcast. So we talk a lot about real estate, but at the kind of fundamental basis of real estate are the people. It's the people that are living on site. It's the people that are moving in, moving out. It's our property management teams. So today we're going to dive into population growth, employment growth, and all things people. So welcome, Ravi.
Awesome. Thanks, Nathan. Happy to be here as always.
As always. Awesome. Let's just dive into it. Why is migration so important? Let's first start off kind of with the big why, and then we'll dive into some of the tools that we use to really kind of pinpoint migration and kind of the data that we look to just kind of find our next market.
Yeah, I mean, that's a great question. It's a great way to start. Migration is pivotal when you're talking about multifamily investing. If you're not considering migration, then you are really, if you're doing well, you're lucky. If you're not doing well, now you know why. You really want to make sure wherever you're investing, there's a path of progress, there's job creation, there's people moving into that area. People have an interest in moving into that area, not only a certain MSA, but you even want to look at the microeconomics of each individual area, because there's certain cities, and one city that comes to mind is Baltimore, where you might have an area that's really popular and people are moving into there, but 2 streets down, people are moving out. So you not only want to look at migration in the city, the states, the cities themselves, but you also want to look migration in certain micro populations in the city. So super important for multifamily because that's where growth is. And if you have growth, you have more people interested in renting, you can increase your rents, and there's more demand for what you have.
Yeah. Ultimately, it's exactly what you said. It's all about growth, right? And that's the whole thing about real estate. It's growth on the rental side of things, on the demand side of things, on pricing and appreciation. The whole kind of basis for multifamily, the whole business plan is to grow. The income, is to grow kind of the lives of the community. It's to grow the ultimate sales price. And that all comes from migration and people's movement. And not only that, but it's also serving their needs, right? Certain demographics are going to have different needs. And it's about how do you position your community or your property to best fit the needs of that renter profile. So, Rob, you talked a little bit about the path of progress. It might be kind of a new term for some listeners. Can you describe what that path of progress is?
Absolutely. So you'll hear this buzzword or buzz phrase a lot, the path of progress. Make sure you're investing in the path of progress. Many syndicators use that. And what that means is you want to invest in an area that's growing. So for example, if you have, let's say you're in Manhattan and you're living in a multifamily complex in Manhattan, you're not really in the path of progress because it's already developed. Say you're living in a Class A building, the building is already done up very nicely. There's no value add strategy. There's no growth. It is what it is. Another example, say you're living in some rural area in the Midwest, and there's really not much growth around there. Everything is fairly stagnant. Again, you're not on the path of progress. You may be living in a nice building, but you're not really living in an area that's growing. So the path of progress is an area that is growing with the nidus, with the focus in maybe the center of a city or some area that has a lot of popularity, and people are branching out from there. So another example in Washington, D.C., where I live, U Street, which is a street in Northwest, and up Georgia Avenue is the path of progress in that particular area, and it was for several years because as U Street grew out, DC grew in population, people started moving into that area and started moving up Georgia Avenue, and then we ended up buying a complex there called the Griffin, a mid-rise, because it was right in the path of progress. And then up to the Griffin, there was growth. And then even beyond the Griffin in a certain area, there's going to be a new development. So there's growth. So that's what the path of progress is. It's an area that's expanding, growing out from an area that's already been potentially developed.
Yep. And you can even see it too. I was talking with a buddy of mine who's doing some real estate in Salt Lake City, and he's doing this new development, and he can literally see the path of progress come down the street over the past 2-3 years, where he's seeing new construction, new development, new businesses. And that's really what the path of progress is the development that typically comes from an influx of business, of employment, and that typically comes with a new tenant profile as well. So who's living in that area. So oftentimes you'll see in a city where the growth isn't equilateral. It's not the same across the entire city. You'll see different pockets within cities grow in different timings too. And that's also an important thing to mention is the path of progress is all about timing, because you may be in the path of progress, but it might not be another 10, 20 years till that path of progress hits your specific location. It's really about being on the forefront where, again, it's that fine balance between, hey, we're in an area that's growing, where there's a new tenant profiles coming into play. There's new businesses that have faith in the strength of the economy in the specific submarket, but we're not in an area that's going to take too long to develop. You want to see development. I mean, it's so funny. I was talking with a friend over the weekend. They were complaining about how much construction and traffic there was. And for me, I love that stuff. That is exactly what I want to see in a city. I want to see development. I want to see growth. I want to see change. Especially when we're talking about real estate, you don't want to be in a stagnant market, or even a market that is losing people or is losing businesses in total.
Yeah. So, another example of this that I can think of, there was a particular deal we were looking at when we first started at Viking, right outside of Chicago. I can't remember the actual name of the suburb or city it was, but somebody was mentioning that, there's huge potential. It's a great area, a great asset. It was, maybe like a B asset in a B area. But at that time, that was like better than what we were looking at, because we were looking at C assets as we were first starting. And they're very bullish about this particular property. But then when we looked at the population growth, and you can do this on your own, in fact, you can look at census data in a particular area, just Google that, and you can see what the trend has been over years. And this is what we did in the past. There's something called CoStar now that does this for us, and we just refer to that. But if you want to do this on your own, go to the US Census, go to their website, and look at the population in a given area over time, and then you can see, in essence, what's happening. Actually, before I will give you another trick as well. You go to U-Haul. So Google U-Haul and then look at the U-Haul growth index, and it'll tell you the growth states. I think there's a way to actually go down to various cities in the states, but it'll basically tell you where the U-Haul trucks are going to and where people are moving to. So that's another way to look at population data. So anyway, this particular asset, we looked at it, everything looked great. The rents were good. We saw a good potential of growth, but then we looked at the census data. We saw that actually the population was declining over time. And we automatically at that point exited, because this was not an area that was growing, it's actually declining. You do not want to be involved in an asset where you have declining population.
Yeah. And ultimately what it comes down to is demand, right? When people are leaving, what that's really signaling is less and less demand for real estate, for business, for the local economy in general. And it all kind of plays into each other. It's all kind of its own ecosystem, which is really cool, right? You can track growth on a nationwide level, or in terms of where people are moving throughout the nation. Right now, there's a ton of growth throughout the kind of the Southeast. You can track growth on the state level. So which specific states, again, within the Southeast are seeing the most growth. For example, Georgia, Florida, Texas, especially during COVID, they saw a huge influx of populations. And then even within the states itself, which cities and which specific submarkets are growing. And if you can find property, again, in that path of progress, that is a phenomenal sign. And again, Ravi gave a tip about U-Hauls. Another great way to look at it is to go to citydata.com. You can see the general median household income of a specific census block. So you can kind of see where the most affluent pockets are, and then also track retail. Really strong retail like Target, Sprouts, Whole Foods, Trader Joe's. These are typically retailers that are associated with more affluent areas. So if you're just looking for, hey, how do I find the path of progress? Honestly, I've done this myself. Go on a map and start tracking those Trader Joe's, the Amazon distribution centers, the Sprouts in that specific submarket. And you can literally visually see, I'm a very visual learner, so this really helps me, but you can literally see where the growth is happening, and then typically where the best properties would be to fuel that growth.
Yeah, that's a great tip, Nathan, because you all know from experience, if you have a Starbucks in a particular area, I mean, Starbucks does a ton of research before they open up a shop. If there's a Starbucks in an area, that's a relatively affluent area. So if you're investing in some kind of asset that's close to a Starbucks, that means something. Retail is a great thing to look at. But on the flip side, pawn shops, right? You guys, Nathan, you look at pawn shops when you're looking at various assets.
Yeah, we look at pawn pawn shops, any cash for gold, any plasma centers. Those are typically indications that people have to sell gold to get liquidity, to get cash on hand. So they might not be the right tenant pool for us to put a full value add with granite countertops and put a lot of premiums on these renovated units. It might be a different type of tenant profile that we're serving in those markets. So when we're talking about, again, migration, what we're really talking about is supply and demand. And something that you can also do to track that demand is something called absorption. So absorption is really the number of apartments or units, I guess in our case, that are coming to a market via the new construction, and how many are getting absorbed, how many are getting bought, how many are getting purchased. Same thing on a rental basis, how many rentals are coming to a market and how many are actually being rented out. So that's a great way to say, hey, if there is job growth in the area, if there's employment growth and employment diversification, and there's absorption, meaning that the units that are coming to market are being bought or being rented out pretty frequently, that's a great sign that it is a growing market. Ravi, can you touch on a little bit about the supply side of things, especially when we're talking about new construction? Because I know that new construction has been kind of tough right now with rising labor costs and with construction loans being more expensive. So we talked a lot about demand and population, but can you touch on the supply side?
Yeah, absolutely. So it's always a good idea whenever you're investing in a particular area to talk to someone in the Center for Economic Development of that particular MSA, because they have their purpose is to build business and to get more folks into that particular MSA. And they want to relay the best data they can to help businesses grow. So if you are investing in a certain MSA and you talk to the Center for Economic Development and say, hey, what kind of new buildings, new multifamily complexes are coming up around here? And they'll say, hey, look, this area is expanding, this is growing, here's what's happening, this is what's, we've zoned this for multifamily and this, that, and the other. So they're really going to try to sell you in that particular area, but they also will give you hard data and tell you what is coming up for development and what is potentially changing. So that's a good resource for you to look at. But then also you want to make sure that in a particular area, there is it's not a low barrier for entry in terms of new construction. And I'll use DC as an example as well. There was a huge housing shortage, and there may still be now. I haven't looked recently, but back in, let's say, the early 2000s, mid 2000s, maybe 2010s, there was a significant housing shortage, and DC just went crazy in terms of new construction. So building a lot of various complexes in the Southeast, Northwest, and these new apartments were being rented, but the absorption actually started decreasing over time because it turned out as the population kind of grew at a certain clip, there were more complexes that were being built, and that decreased the overall demand for rentals. And for many years, there was an issue of finding tenants. And, I have some personal properties in DC, and we never experienced any vacancy. In fact, for many years, we had lines of people outside waiting to rent our units. But then when this happened, we ended up having vacancy. So you just want to make sure wherever you're investing, there is a maybe steady supply of complexes, but there's not so much growth that it outweighs what's already present, because that could be a problem too. This happened in Houston. This is an issue. There's a significantly higher vacancy because there's no zoning in Houston, and there's a lot of build out, and not the absorption isn't as high as it should be.
Yeah, it goes back to that whole balance between supply and demand, which is. It's interesting because for me, supply, especially on the multifamily side of things, is always a lagging indicator, right? It takes a year, 12 months plus at least to build these communities. So you have all this sense of demand. You have, I'll take COVID, for example. You have all these people moving into the Southeast, right? There's all this demand. People are moving. There's more freedom in terms of, work from home. There's not as tied down to specific locations. So you saw a lot of, net migration out to, sunnier states that had lower costs of living. And so you had all this demand, and then you have all these development companies that are trying to keep up with that demand. So they have a ton of supply that are coming to the market. They are building, especially during COVID. You saw a lot of new construction, especially with the cheap debt. But there comes almost this inflection point where that demand starts to cool down a little bit, but you still have this entire pipeline of these new construction deals, all the supply that's built up. And so what you typically see in some of these markets is you have this influx of supply, you have all this built up demand as well. And then eventually, once that demand cools down, you have oversupply. That's what we're seeing in some markets now too. They're seeing an oversupply where there's still construction that's coming to market, but because the demand's cool and because there's a little bit more, I guess, uncertainty now in some of these markets, that supply isn't being absorbed as quickly. So that's probably, potential risk for the short term, but still, medium to long term, there's still a severe housing shortage. I forget the exact number. I think it's like close to 5 million now of specific units that still need to come to the market to keep up with demand. So Robbie, can you talk a little bit about the shift that we saw during COVID, specifically in terms of not only the migration patterns, but the tenant preferences that we saw and how kind of COVID changed the landscape for multifamily?
Yes. So, as Nathan mentioned, tremendous migratory shifts into Texas, into Florida, into South Carolina, North Carolina, into Virginia, into Arizona. You're seeing a lot of people shifting into those areas, and they're coming out of California, Illinois, Michigan, Massachusetts, New York. So you're seeing tremendous shifts away from those particular states into the states I mentioned earlier. And there is something called a flight to quality. And this is what we're seeing as well, and that people are renting by choice, not because it's a necessity. And they want to rent in apartments in these new areas that they're moving into that are high-end places that have the amenities that they enjoy, and they have the salaries and money to do so. And that's what we have noticed at Viking, in that there's a flight to higher quality. There's renters by choice. And if you capitalize on these types of assets, you're going to get a tenant base that's going to pay rent, that's interested in amenities, that has no problem, increasing or paying for increased rents, 100, 200, 300, whatever it may be, because that's really an insignificant part of their overall income. So that's what we've seen with, the pandemic. We've also seen on the flip side that the C-class complexes, those have taken a hit in a lot of areas because tenants in those particular areas are more working class tenants. It may be that they don't have the most stable jobs, and especially in areas where there's population exodus, they are taking a bigger hit, and those people are those complexes are running into some financial difficulty. So that's what we've seen in terms of the supply demand economics.
Yep. Yeah, absolutely. And it's interesting too, if you think about the type of tenant or the type of kind of resident that is able to move and then have that flight for quality, there typically takes some level of affluence, right? Especially just to move alone is an expensive endeavor. So those that didn't have kind of, I guess, the financial luxury probably stayed put, probably didn't move during the pandemic. It was that tenant profile that was able to move, that was searching for something different and say, hey, I don't really like where I'm living, and let me kind of find somewhere that fits my needs better. And again, we saw those apartment communities that were able to serve, outdoor spaces, co-working spaces, smart technology, cable packages. You saw those communities that were able to really kind of serve that tenant profile do really well during the pandemic. So, Robbie, I know we've talked about the supply side of things with new construction. We've talked about the demand side of things. How does that really fit into kind of the different, I guess, property types that, a potential renter could choose? They could choose, an A class, a B class, or a C class. Can you kind of define what kind of renter fits into each one of those pools, and then what we serve at Viking?
Yeah, absolutely. So, as Nathan mentioned, you can grade apartment complexes several different ways, and one of them is by classes. So when somebody says an A-class complex, that's a very nice, newer vintage complex, and you'll see those in multi-use, nice shopping centers, maybe close to where you live. A lot of amenities, very high end, that's everything. Then you get to the C-class complexes, which are more working class complexes. They may be single or double level complexes, garden style, and they're usually 1960s, 1970s vintage, so older complexes. And then you have everything in between, which is B class. So what we've noticed, and I alluded to this before, is that the C class is a gamble. You could potentially make a lot of money in C class if you're investing in the the right complex at the right time, but then also you could potentially lose a lot. We've seen things go both ways because those tenants are typically, unfortunately, the hardest hit. B class is somewhere in the middle. A class is a safer type of investment because those people, as I mentioned before, they can pay rent. They're usually quite well to do, but there's not as much margin there for a value add because those complexes are already really fully capitalized and they look great. Now, what we are looking for is those kind of the A minus space where you have say like a 2005, 2010 vintage property. You can do some value add, some maybe light value add, maybe some of those automations that Nathan was mentioning. Maybe you put a backsplash and some new fixtures and things like that. So minimal type things, but the tenants will pay like that extra rent bump, that extra 100, 200 or whatever it may be for those small changes. We're looking for those types of complexes, and that's where we see a lot of value to be had.
Yep, absolutely. And it's funny, you'll see a lot of new construction kind of pop up in B minus spaces, kind of in that path of progress that we talked about, which is kind of the whole idea, right? You want to bring a new kind of demographic to those areas that are in that kind of growth phase, because it's a little bit tongue in cheek almost, but ultimately to get a premium for a value add unit where you're doing a renovation, two things need to happen. You either need to have the current tenant profile be able to afford and value the renovation that you're putting on the property, or you need to have a new tenant profile come in and again be able to afford it and to pay for those renovations. And that's something that's a little bit overlooked, is that if you have a property that's not in that path of progress, that's not in that kind of growth mode, it can be really difficult to pull a new tenant profile onto that property, just because of the type of demographic that's living in that area. It's very hard to convince somebody to move from an A class area into a B minus space. So that's why, yeah, exactly, we love kind of the newer vintage properties that still have some sort of value add component, because it kind of serves kind of both sides of the equation.
Yeah, so, and just to add another resource that you all can look at, and this is a really interesting resource. In fact, even if you're not investing in multifamily, I find it fascinating to look at. It's called the Justice Map. So it's justicemap.org. I don't know how updated the data is here, but they actually will go over the demographics, so race, and then income for the community and various parts of the country. So if you're interested in looking at the income in your area, and it'll really break it down, and you can see the income there and the surrounding of that particular area. If you're looking at it, you want to look at the income or demographic in a place that you want to invest in. You can do that with Justice Maps. It's another data point that you can use to make decisions.
Yep. And some of the best resources too, outside of all the technology and all the software, is just having boots on the ground, right? Having somebody from your team that knows the area, has lived there, or even going to visit that area yourself. The kind of Google Maps and the census data can only tell you so much, but really kind of getting on site and living that experience, you're pretty, trust your gut. You have a really kind of innate ability to assess the growth of an area and kind of the safety of an area. And if you kind of go there and see the growth that's happening, see, the interaction with the locals, that's a phenomenal way to gain location specific intel without having to rely so much on softwares or on numbers alone.
Absolutely.
Awesome. Robbie, this has been a phenomenal discussion. I always love talking about people, so glad we got to dive into that in addition to the real estate. Anything else you want to add before we wrap up?
No, I think you summarized it very well, Nathan. I mean, again, migratory patterns, migration is super important when you're looking at multifamily assets. We gave you some good resources to tap into if you're doing your own search. The other thing I just would like to add is if you're doing your own search and you have a broker, ask them for CoStar data, because the CoStar platform is quite expensive, but many brokerage firms, almost all of them, have access to it. So you can get CoStar data from your broker, and that has all this stuff clearly laid out for you.
Awesome. Thanks, Robbie. Always a pleasure.
Thanks, Dave.
See ya.